If you zoom out far enough, the chaos of the daily news cycle disappears. The noise of the stock market tickers fades away. And what you are left with is a single, undeniable heartbeat that has been pulsing for 100 years. Most people never hear this heartbeat. They are too distracted by the panic of the moment. They are too busy chasing the next hot stock or worrying about the next election. But for the few who do hear it, this heartbeat is the secret to generational wealth. It is the sound of a pattern that has repeated itself through every major financial disaster since the invention of the modern economy. We are told that history is just one random event after another. We are told that the Great Depression was a fluke, that the inflation of the 1970s was an anomaly, and that the 2008 financial crisis was a once-in-a-lifetime mathematical error. But that is a lie. These events are not random accidents. They are part of a cycle. They are the inevitable result of human psychology and the mechanics of debt. And because they are part of a cycle, they can be predicted, not the exact day, not the exact hour, but the arrival of the storm itself. Look at the wreckage of the last century. 5 distinct monsters have risen from the depths to destroy the wealth of the middle class. First, the Great Depression of 1929. A deflationary black hole that sucked the value out of everything, destroying 89% of stock market wealth and leaving a generation with nothing but dust. Then, the 1970s, the decade of stagflation, where the money in your wallet rotted away, losing its purchasing power day by day while the economy stagnated. Then came 2008, the great financial crisis, where the banking system itself suffered a cardiac arrest, wiping out $10 trillion of household wealth and proving that even the biggest institutions can fail. Then the COVID-19 crash of 2020, the fastest, most violent downward spiral in history, dropping 35% in 3 weeks. And finally, the 2022 inflation shock and bear market, which crushed the dreams of speculative investors and erased 70% of the value of high-growth technology stocks. Depression, inflation, banking collapse, pandemic, rate shock, 5 completely different enemies, 5 completely different ways to lose everything. When the average investor looks at this list, they feel paralyzed. How can you possibly prepare for all of this? If you buy stocks, a depression kills you. If you hold cash, inflation kills you. If you buy bonds, a rate shock kills you. It feels like there is no escape. It feels like the game is rigged against you. And in many ways, it is. The game is designed to transfer wealth from the impatient to the patient, from the reactive to the prepared. But there is a flaw in the matrix. There is a loophole. Across all 5 of these catastrophes, spanning 100 years of war and peace, there were 3 specific positions that survived every single time. Not 4 positions, not 10 complex hedge fund strategies. Just 3 simple assets. The same 3 assets that protected a family's fortune in 1929 were the same assets that worked in 1973. The same assets that worked in 2008. And the same assets that are working right now. This is not a theory. This is a mathematical reality. Warren Buffett, the greatest investor of our time, currently holds 30% of his massive conglomerate in position number 1. Central banks, the architects of the global financial system, are currently buying position number 2 at a pace we haven't seen since the end of World War II. And despite every panic, every crash, and every headline screaming that the world is ending, position number 3 has quietly delivered 10% annual returns for a century straight. By the end of this audio, you will understand exactly what these 3 positions are. But more importantly, you will understand why the smartest investors in the world, right now in 2025, are moving billions of dollars into this exact formation. They see what is coming. They hear the heartbeat. And they know that understanding this pattern gives you the one thing that money usually can't buy. Certainty. Not the certainty that you will never see a red day in your portfolio, but the certainty that no matter what crisis comes next, you will be the one left standing. To understand why this works, we have to strip away the complexity of modern finance. Forget about derivatives, options, and crypto yield farming for a moment. Financial markets, at their core, only exist in 3 fundamental states. Just like water can be liquid, ice, or steam, the economy can only be in one of 3 phases. And each of our 3 positions is the ultimate shield for one of these phases. The first state is deflation. This is the winter. This is the crisis. In this state, credit contracts, banks stop lending, and the price of assets falls off a cliff. The biggest danger here is not missing out on gains. The biggest danger is insolvency. In a deflationary crash, cash becomes the most valuable asset on earth because it is the only thing that allows you to survive. The second state is inflation. This is the fire. This is when governments, terrified of the deflationary winter, turn on the printing presses. They flood the system with currency to stimulate the economy. But in doing so, they destroy the value of that currency. In this state, holding paper money is suicide. You need hard assets, things that cannot be printed by a bureaucrat. The third state is growth. This is the summer, the recovery, the expansion. This is when human ingenuity, technology, and population growth drive corporate earnings higher. In this state, you need to own a piece of the productive economy. You need equity. Every financial disaster in history is simply a violent transition between these three states. The mistake most people make is that they bet everything on one state. They bet everything on growth, and they get wiped out in deflation. Or they bet everything on deflation, and they get left behind during inflation. The secret of the pattern is that you don't try to guess the weather. You build a house that withstands the wind, the fire, and the rain. You hold all three positions simultaneously. Let's travel back in time to prove this. Starting with the ultimate nightmare, the Great Depression. The year is 1929. The Roaring Twenties are in full swing. Taxi drivers are giving stock tips. The shoe shine boy is buying on margin. Everyone believes that stocks have reached a permanently high plateau. And then, in October, the floor falls out. Over the next 3 years, the stock market collapses by 89%. Imagine having $1 million and watching it shrink to 100,000. Families were ruined. Suicides skyrocketed. It was a deflationary apocalypse. But let's look at position number 1, cash and treasury bills. In 1929, the dollar was backed by gold. As stock prices crashed, the purchasing power of the dollar went through the roof. If you held cash, you didn't just survive, you became a king. A dollar in 1932 could buy 3 times as much food, land, and labor as a dollar in 1929. The legendary investor Bernard Baruch famously sold his stocks before the crash and sat in cash. While his friends were going bankrupt, he was buying up entire corporations for pennies on the dollar. He used position number 1 to capture the opportunity of a lifetime. Then, look at position number 2, gold. Throughout the early years of the Depression, gold preserved wealth. But then, something extraordinary happened. In 1934, President Roosevelt, in a desperate attempt to fight deflation, devalued the dollar against gold. Overnight, the official price of gold was raised from roughly $20 to $35 an ounce. That is a 69% instant gain for anyone holding gold. While the rest of the country was standing in breadlines, gold holders saw their wealth nearly double in nominal terms. Position number 2 protected them from the government's intervention. And finally, position number 3, the S&P 500, or the stock market index. This is the hardest pill to swallow because, in the short term, it lost 89%. But this is where the secret of time horizon comes in. If you had bought the very top in 1929, the worst possible timing in history, but you refused to sell, if you just held on, you would have eventually recovered. By 1945, you were back to even. By the 1950s, you had doubled your money. By the 1960s, you had quintupled it. The Depression was a deep hole. But the American economy eventually built a ladder out of it. Position number 3 is the engine that drives you out of the abyss, provided you have the patience to wait. Now, fast forward to the 1970s. The script flips completely. We moved from the ice age of the Depression to the fire age of stagflation. The Vietnam War and social spending had drained the U.S. Treasury. In 1971, President Nixon shocked the world by taking the dollar off the gold standard. The link was broken. The printing presses roared to life. Inflation hit double digits. If you held cash in a mattress during the 70s, you were being robbed. Your money was losing 10 to 15% of its value every single year. But look at how the pattern adapted. Position number 1. Treasury bills changed their behavior. As inflation rose, the Federal Reserve raised interest rates. By 1981, short-term Treasury bills were paying 15% interest. If you held these bills and kept rolling them over, you earned enough interest to offset the inflation. You didn't get rich, but you didn't bleed to death like the people holding long-term bonds, which lost half their value. Position 1 acted as a shield. But the real hero of the 1970s was position number 2, gold. This was the decade where gold proved why it has been money for 5,000 years. Gold started the decade at $35 an ounce. By January 1980, it touched $850 an ounce. That is a 24 times return in 10 years. Think about the magnitude of that. If you had just 5% of your portfolio in gold, that small sliver would have exploded in value, covering all the losses in the rest of your portfolio. Gold sniffed out the currency debasement and repriced the dollar in real time. It proved that when faith in governments collapses, faith in gold remains. Meanwhile, position number 3, the stock market, went nowhere. The Dow Jones was flat for almost 14 years. But again, it didn't die. It paid dividends. It survived the fire. And the moment inflation was killed in 1982, the stock market began the greatest bull run in human history, rising almost uninterrupted for the next 18 years. Do you see the rhythm? In the 30s, cash and gold won. In the 70s, gold and cash won. The specific winner changes, but the portfolio survives. Now, let's bring this into the modern era, the era that you and I remember. The global financial crisis. The world felt like it was ending. Banks that had stood for 100 years collapsed over the weekend. The credit markets froze. This was a deflationary shock, similar to 1929. Position number 1, cash, became oxygen. Liquidity disappeared. Those who had cash, like Warren Buffett, became the masters of the universe. Buffett invested billions into Goldman Sachs and General Electric when they were on their knees, securing deals that paid him massive dividends for years. He could only do that because he held the fortress of cash. Then, the government panicked. They printed trillions of dollars. This triggered position number 2. Gold, after an initial dip, rallied hard from 2009 to 2011, hitting record highs as investors feared the death of the dollar. And position number 3? The S&P 500 fell 57%. It was painful. It was terrifying. But if you closed your eyes and held on, you not only recovered, you entered a golden age of technology and growth that turned every dollar invested in 2009 into $6 by 2021. Then came the pandemic. 2020. The pattern accelerated. What took years in the 1920s took weeks in 2020. We saw a deflationary crash, followed immediately by an inflationary stimulus. The government sent checks to every household. The Fed bought corporate bonds. Position 1 protected you in March. Position 2 protected you in August when inflation fears spiked. And position 3, the recovery trade, created millionaires out of teenagers on Robinhood. And finally, 2022, the hangover. Inflation spiked to 9%. The Fed slammed on the brakes. Stocks fell. Bonds had their worst year in history. Crypto imploded. But look at position number 1. For the first time in 15 years, Treasury bills started paying 5% risk-free. Cash stopped being trash and started being a valid investment. Gold, in a year where stocks and bonds were both down double digits, held its line. It ended the year flat. In a bear market, flat is a victory. It acted as the anchor. 5 crises, 5 different monsters, 1 surviving portfolio. So, let's define these positions clearly, so you can execute this strategy yourself. Position number 1 is the fortress. This consists of cash and short-term U.S. Treasury bills. Many people think cash is a waste. They think it's lazy money because inflation eats it. But they are missing the point. Cash is not an investment for return, it is an investment for optionality. Optionality is the most valuable thing in the world during a crisis. When the market crashes 50%, the person with no cash is forced to sell their assets at the bottom to pay their bills. They lock in their losses. The person with cash is the one who buys those assets. Cash allows you to play offense when everyone else is playing defense. Treasury bills are simply cash that pays you interest. They are the safest asset in the financial world because the US government can always print the money to pay you back. In 2025, with rates hovering around 4 or 5%, this position pays you to wait. Position number 2 is the insurance. This is gold, and I mean physical gold or a physically backed ETF. Not gold mining stocks, which are volatile companies. Gold is a singular asset. It is the only financial asset that is not someone else's liability. If you own a bond, you are trusting the government. If you own a stock, you are trusting the CEO. If you own a bank deposit, you are trusting the bank. If you own gold, you are trusting physics and history. Gold cannot be hacked. It cannot be erased. It cannot be printed. It has a limited supply and 5.000 years of demand. When the debt burden becomes too high, governments always choose to inflate the debt away. They choose to devalue the currency. Gold is your insurance policy against that decision. You don't hold gold to get rich. You hold gold so you don't get poor when the system fails. Position number 3 is the engine. This is the S&P 500 index. This represents the top 500 companies in the American economy. Apple, Microsoft, Amazon, Google. These are the companies that change the world. They have pricing power. They have innovation. They have the best talent. Over long periods, human productivity always increases. We find better ways to do things. We invent the internet, the smartphone, artificial intelligence. Position number 3 captures that growth. This is the wealth compounder. This is what turns $10,000 into $1 million over 30 years. But the price of admission for this growth is volatility. You have to be willing to watch it drop 30% or 50% without selling. That is why you have position 1 and position 2, so you never have to sell position 3 at the wrong time. Now, look at the world right now. 2025. Why is this pattern screaming at us today? Because the setup is perfect for another crisis. The United States national debt has crossed $36 trillion. The interest payments on that debt are now higher than the entire defense budget. This is a mathematical trap. The only way out is for the Federal Reserve to print more money to buy that debt. That means future inflation is almost guaranteed. Look at what the smart money is doing. Warren Buffett, the Oracle of Omaha, has been aggressively selling stocks. He has sold half of his Apple position. He has sold Bank of America. He is not buying new companies. He is building a mountain of cash. Position number 1. He now holds over $325 billion in short-term treasuries. This is the largest defensive position in his life. He is telling us, without saying a word, that the market is overpriced and he is waiting for the crash. Look at the central banks. China, Russia, India, Poland, Turkey. For the last 3 years, they have been buying gold at a record pace. They are diversifying away from the US dollar. They are preparing for a world where paper money is weaponized or devalued. They are loading up on position number 2. They know that when the debt crisis hits, gold will be the only neutral reserve asset left. And yet, despite the fear, position number 3, the S&P 500, hovers near all-time highs. Driven by the AI revolution, the engine is still running. The growth is still there. So how do you position yourself in 2025? You don't have to be a billionaire to follow the pattern. You just need discipline. If you are young, under 40 years old, your biggest asset is time. You want to capture as much growth as possible. A solid allocation based on this pattern would be 20% in cash and treasury bills. This is your dry powder to buy the next crash. 10% in gold. This is your insurance against monetary stupidity. And 70% in the S&P 500. You can afford to take the volatility because you have decades to recover. If you are middle-aged, between 40 and 60, you have more to lose. You need a balanced approach. Increase your fortress. 30% in cash and treasuries. Keep 10% in gold. And lower your risk slightly with 60% in the S&P 500. If you are approaching retirement or already retired, preservation is the priority. You cannot afford a 50% drop right now. You might move to 40% cash and treasuries, 10% gold, and 50% S&P 500. This ensures that no matter what happens in the next 5 years, deflation or inflation, your lifestyle is protected. Most people listening to this will do nothing. They will nod their heads, agree that it makes sense, and then go back to chasing the latest meme coin or panic selling when the news gets bad. They will try to time the market. They will say, "I'll sell everything now and buy back when it's lower." But they never do. They sell at the bottom and buy at the top. They are victims of their own psychology. But a small group of you will take action. You will realize that the goal of investing is not to get rich quick, but to get rich for sure. You will realize that the all-weather approach, holding the fortress, the insurance, and the engine, is the only way to sleep soundly at night in a world of chaos. The next crisis is coming. It is a mathematical certainty. It might be a sovereign debt crisis. It might be a geopolitical conflict. It might be a liquidity crunch in the banking sector. We don't know the name of the monster, but we know it's walking toward us. When it arrives, there will be two types of investors. There will be the ones who are forced to sell, who watch their life savings vanish, who scream at the television. And there will be the ones who are positioned, the ones who have cash to buy the deals, the ones who have gold to withstand the inflation, the ones who own the businesses that will lead the recovery. History has handed you the blueprint. It has been stress tested for 100 years. It has survived the depression, the war, the stagflation, and the pandemic. The pattern is clear. The signal is loud. The only question remaining is not what the market will do. The question is, what will you do?